Welcome, everyone. It's Angelo Robles, host of the Angelo Robles podcast and the founder and CEO at Family Office Association. Today, we're covering Optimize Your Future with Decentralized Finance, DeFi, investing for the next 5 years. It features Qiao Wang of the Defi Alliance. I just love Qiao. We caught up a couple of months ago through a mutual acquaintance in the industry. I started to follow his Twitter. He is a great follow and has a significant following on Twitter, and really, really creative in terms of kind of the new world that we're looking forward to from the digital asset ecosystem perspective. To give a little bit of context, although DeFi is going to be an anchor of what we're going to cover today, decentralized finance comparative to centralized finance. But it's going to be deeper than that. We will cover Bitcoin, Ethereum, Doge. Of course, you have to include Doge in like every conversation these days. NFTs, and broadly again about the digital asset ecosystem. I believe, and many of you would agree, we're still in the early stages. The inefficiencies in the market and the growth potential allow the asymmetrical opportunities for those of you who are active investors. Volatile, for sure. A bubble, perhaps. But if you're looking at it more long term, to think that we're going to go from analog to digital back to analog, meaning from a worldly perspective, I think that's kind of ridiculous. Much of this will be here to stay, but again, volatile. So Qiao Wang, welcome to the show. Very exciting to have you on.
Great to be here. Thanks for having me, Angelo.
Thank you. Why, in your opinion, is it so important to understand and interact, that's a specific word I'm using, with digital currencies, including inevitably central bank digital currencies, crypto, understanding wallets, DeFi, social tokens, kind of the whole digital asset ecosystem? Again, maybe only a small percentage of the population has somewhat dove in. What advantage are they going to have? And is there any advantage to waiting on the sidelines to at least form your own thesis and make your own think for yourself?
This is a really good question, and we can just talk about this one question for hours, because there's so many.
Well, we'll try to keep it 5 minutes.
This touches basically everything about crypto. I think for me, the most important thing that will appeal to the average person is the user experience. The crypto user experience is fundamentally different from, let's say, traditional finance, traditional banking user experience. When you wire some money with your bank, if you do for a small amount of money, you can do it online, and you're gonna wait maybe a business day to get it settled. But if you try to wire transfer relatively large sums, sometimes you get a call from your bank asking you why you're doing this. It's almost as if the money is not yours, right? I mean, the truth is, when you deposit money in the bank, the money is not really yours yet. It's an IOU that the bank has for you. When you try to do the same thing in crypto, for instance, you have full control of all your assets. You have full freedom of what you want to do, and no one will tell you you cannot do this. That's why user experience for crypto is so important, so fundamentally interesting. This is one of the many examples of why crypto is interesting. Obviously, there are trade-offs here, right? Like with banking, someone else is taking care of the safety and the security of the money for yourself. Whereas with crypto, you have to take care of that yourself. So there's a trade-off. It's not strictly better, but it's fundamentally different and interesting. So that may appeal to many people like myself. So for me, like, user experience is really the number one thing that will appeal to the average person. Obviously, right now, in 2021, the crypto still has a lot of issues, like scalability, for instance. Fees are high. When you transfer some money on Ethereum, you might have to wait, tens of seconds and pay a fee of like $50 to transfer $5 worth of, USDC, etc. But I think these are technological issues, challenges that can be solved over time. And, within the next 5 to 10 years, user experience are going to get even better and better.
Yeah, I mean, I have some opinions about that very broad-based question that I asked, and this will absolutely apply to people that elect to stay on the sidelines and not get involved. First of all, do your own research and form your own thesis. Saying that you don't invest in what you don't know when this is such potentially a tremendous opportunity is foolish. Begin to know. And by the way, you don't really know how the plane you get into flies. You don't need to be a PhD, a rocket scientist, or a cyberpunk, but you should be able to put in some level of research to form your own thesis, even if that thesis ends up being one sentence from the time that you put into it. And if you're going to stay on the sidelines, I'll respect you for forming that thesis because you did some of the research. Second of all, especially in what you're doing in DeFi, it's if you're in certain industries, maybe small banks is going to be one, insurance brokerage, or any third-party intermediary, your world is going to change. It may not be changing tomorrow or next year, but it's coming. And you should be prepared for that. You should adapt to what's going on. The future of jobs. And when we get to the digital wallets, you're kidding yourself if you don't think we're going to have central bank digital currencies and programmable money and government control from that perspective. We're going to get into that. At least you'll have familiarity with that ecosystem and how to navigate it and understand it. Oh, and by the way, potentially asymmetrical, but certainly you could lose, absolutely. But much greater potential return because it's so nascent early on in such, for now, an inefficient market. Why don't we begin more classically? DeFi is the Lego of crypto finance. Explain what that comment means to you.
Again, this is a really good question, and this relates back to the first question, actually, like why is DeFi fundamentally interesting? Is that in many ways, it's different from traditional banking in the sense that in the traditional banking or traditional finance, services and products they very much live in silos. Like for instance, when you have some stocks in interactive brokers, and you want to, I don't know, move that into some other bank account or brokerage account, it's not simple. It's not easy. There is friction there. Like you have to get permission from your brokerage account, and then it takes a few days to get the money transferred. Now, in DeFi, to answer your question, why is DeFi different? Is because these different products and services, they're not siloed. They can interact with each other. They can interoperate with each other through programmable interfaces. And the key fundamental thing about these programmable interfaces in DeFi is that they are entirely permissionless. Anyone can build on top of them without having to worry about getting deplatformed. So for instance, in traditional banking, these brokerage accounts or bank account, some of the services, they actually provide developers with an API, with a programmable interface. But these interfaces are not permissionless. They are fully controlled by the company itself. So there's always a risk of getting deplatformed. And that's why DeFi as a money Lego is so fundamentally interesting, because you can program different services on top of each other. So it's a stack on top of each other. So that's how I think about the money Lego aspect of DeFi.
Yeah, I think that's really important. And even taking a little bit of a step back, the opposite of DeFi, decentralized finance, is centralized finance. And I know for people, and this is relatively all newer to me, so I understand it's a little bit hard to swallow some of this. We are used to, well, I deal with a bank, I deal with an insurance company. They're centralized. They have a board of directors. They have a CEO. In decentralized, do you understand? There's none of that. I mean, it truly is decentralized. There's not one computer you go and pull and that company's gone. It's a completely different paradigm. When you're at the earliest stages explaining DeFi to, say, business leaders, Qiao, that know nothing about it, like what's the most simple definition that you give so they could begin to wrap their arms around that?
Definition for DeFi, or
yes?
It's a really good question. I would say DeFi for me is a set of financial services and products that are built on open, borderless, permissionless blockchains. For me, that's the one-liner. Obviously, each and every one of these words need some expanding. But for me, the two most important consequences of this definition is, one, the users have full freedom and full control of their assets. And two is that the developers can build on top of this platform and these interfaces in a fully permissionless way without having to worry about getting the platform. I think these are the two most important consequences of this definition.
Yeah, no, that's great. And I'm chuckling to myself if talking to a bunch of business leaders in traditional businesses like some that I described, and you're talking about DeFi, no board of directors, no C-level executives, they're probably like, oh my God, what is that going to mean for me and my future and my job? We'll get to some of that shortly. Let me go in a little different direction. I do like to bounce around. The current hot topic most recently have been NFTs. SZNS is a platform that allows creators and curators to create custom baskets of NFTs.
Yeah. Sorry, what's your question?
Give our audience a little bit of context to that. I mean, NFTs have really exploded lately, and how that plays into the the SZNS that I noted, et cetera.
Yeah. So Seasons is one of the projects that the Defi Alliance invested in recently through Twitter. By the way, Twitter is just a really amazing tool for connecting people in crypto. I think Twitter is what LinkedIn has always meant to be in terms of connections and networking. But Seasons is building a to your point, a platform for people to create I guess funds of NFTs, and basically to solve the problem of the lack of liquidity with NFTs. So what is an NFT, right? Like NFT stands for non-fungible token. So basically for every token, you really only have one unit of it. And that's the opposite of fungible tokens, where, for instance, for a given asset or given contract, you can divide it into many multiple units. For instance, a stock or a futures contract. These are fungible tokens. But for something like a unique collectible, a physical collectible, there's only one unit of that. And that is what a non-fungible token means. And given this property, there is a lack of liquidity because you only have one unit at a time. It's very hard for price discovery to happen, right? Like you cannot, like with fungible tokens, you can trade very frequently and very continuously among multiple counterparties. And that's not necessarily the case with non-fungible tokens. So there is a lack of liquidity. There's a liquidity problem with non-fungible tokens. And that's what the problem that the Seasons is trying to solve, is to create fungible funds out of these non-fungible tokens. Now, to answer your other question, like non-fungible token, it's very like mathematical, computer sciencey kind of concept. What is some of the applications of non-fungible tokens? So far, we've seen, in January, February, we've seen things like NBA Top Shots,
right?
Some of these digital collectibles and digital gaming items that the average person can really appeal to. Can really that really appeals to the average person. Like they understand intuitively what is an NBA Top Shot card, like a moment or a gaming item. But for me, there's an even bigger set of applications that we haven't really begun to explore yet, and that's the intersection between NFTs and DeFi. Because in finance, there are actually a lot of things that are non-fungible. Like for instance, insurance contracts generally are non-fungible. Like you have a very specific set of terms between you, the buyer of the insurance, and the provider of the insurance. Like some of these things are really like they're totally non-fungible, and we haven't really begun to explore like this area yet. And I think that's the biggest area to for me in the coming years in terms of NFTs.
Yeah, from you and your perspective, that's really a good point. Some people look at it as digital art, and potentially that's a part of it, but it's much deeper. What it could do to the influencer market, how they could benefit and profit. And I've learned how to create an NFT. I mean, all of us, if I could do it, any of you could do it. And going through the immersive and hands-on experience and understanding it is very, very important. So I would definitely recommend that. But back to that music industry, and we have some guests coming on next week, one that had a #1 Billboard hit back in the maybe 12, 13 years ago. This is really an exciting market for those. And I know this is springing on many of you really just in the last couple of months. And again, volatile, a bubble possibly, but it's not going to disappear. Do you understand that? It's going to be around. And I think I want my audience to really, especially those that are more novice and new to this, for that to really sink in. A question for you, Qiao. Are baskets and token sets the future of DeFi?
When you say token sets, you mean the token set project itself, or?
Yes, let's go.
I mean, I think it's definitely a critical, a big component of DeFi, right? Like, you know, the analogy in the traditional finance, I like using analogies for traditional finance because of your audience. But the analogy is, you know, ETFs, for instance, right? An ETF is a basket of, let's say, single stocks or, you know, individual like commodities, right? You know, the fact that ETFs has grown so big over the last couple of decades in traditional finance tells me that something similar is going to happen in DeFi. Like, people just have a natural need for trading indices, for trading a macro sector rather than individual components. So I mean, for sure, it's going to be something. I mean, in fact, so far, like, you know, token set, the product itself has launched a few index funds in DeFi. The most prominent one is called DPI, and it has I don't know what the latest volume is. It's on the order of 8 figures or 9 figures in terms of asset under management, and it's growing. So it's definitely a big part of the future of DeFi.
I mean, I spoke about this next topic earlier in our discussion, but in my Instagram post, I've been hinting at it. You know, DeFi, decentralized finance, will disrupt centralized finance, known as CeFi, because every financial product and service, such as payments, loans, investments, and insurance, will be managed by smart contracts instead of third-party centralized intermediaries. Maybe let's give one example so my audience could wrap their arms around it, and that would be banking. In my opinion, the big giant banks, Goldman, JP Morgan, Morgan Stanley, they're not going anywhere. They're part of the plunge protection team. They're part of what makes a lot of this run. They have truckloads of money. They have more younger talent into this stuff than you think they do, and they're going to be an active force. But I don't know if I would want to be a smaller to mid-sized bank, because I think that could get disrupted. If you could explain why DeFi, and then maybe I'll go into a little bit of the government, central bank, digital currency, and programmable money. That's going to be a 1-2 punch they're going to have a hard time dealing with in a couple of years.
The way I think about DeFi disruption of CeFi or centralized finance is not that DeFi will completely destroy centralized finance, but instead what's going to happen in the next decade or two is that centralized finance companies are going to start to build in DeFi platforms. They will entirely pivot their tech stack into this new tech stack, because this new tech stack is actually superior, once again, from a user experience point of view. The products that they offer, the assets, the friction around using these assets and using these products will be massively reduced when you build these products in decentralized platforms. And once again, like the analogy here is, if you think about like New York Times or like traditional media, if you look at their business today, there's no more like physical newspapers. All their stuff lives online. And basically what happened is the internet, yes, the internet did disrupt these traditional media companies, but what really happened was these traditional media companies, they started building their products on the internet itself. And I think that's exactly what's going to happen to DeFi and CeFi. Like Morgan Stanley, all the banks, big or small, they're going to build products in DeFi 1 to 2 decades from now.
For sure. And I think people have to realize the classic way that centralized smaller banks loans would have been a big part of how they profit and what they do. DeFi is going to completely disrupt that. And there's a truckload of people that are unbanked that are going to have much more flexibility in the DeFi world than they ever had in any kind of centralized world. From my perspective, that's one punch. The other one, central bank digital currencies, Jerome Powell has recently spoken about it. Is it going to happen in the next 6 months? No, it is inevitable. It's not going to take 10 years. And what that means is the government is going to have complete control of that in a centralized platform and programmable money. Maybe if you're not spending it, you get charged interest. Who knows? We don't know what direction that's going to go. But here's what it will do. For the most part, especially via the wallets and how they structure it, savings and checking accounts, especially for the masses, which again, I'm talking more mid to smaller size banks here, it's not really going to be needed. I mean, that industry, there's no question. I could mention accounting. I think the big firms, the KPMGs of the world, they're fine. They have money, they hire creative people, they're doing a lot of things on the blockchain. But what programmable money could potentially also do, this is a little scary, but they could tax you, the government, and make it really efficient for them, highly efficient. So small accounting firms could be threatened. Intermediaries in insurance, there's already a couple of insurance platforms kind of taking off on DeFi. I don't want to scare people, but some of them may say, oh my God, if this is around the corner in 3 to 5 years, how do I adapt my skill set? How do I learn? And how could I thrive in an upcoming future? What advice would you give them, Qiao?
I would say number one, get on Twitter and follow the best people there. It's literally, Twitter is literally, you know, the single best source of information when it comes to crypto. Back in the day, it used to be Reddit, but for some reason, everyone moved to crypto. So moved to Twitter. So you have to be on Twitter, and it's gonna take a while. Like you might feel intimidated at the beginning because the way crypto native people think is just so different from, you know, the traditional finance people. I by the way, I come from a traditional finance background, so I know how things sort of work, the culture in both worlds. In traditional finance, people tend to be, relatively speaking, more secretive, you know, more competitive. Crypto is the polar opposite. Everyone is so collaborative, share information. Even the funds like that are like the hedge funds, you know, they share alphas with each other. It's just unbelievable. Like people are way more collaborative than competitive. So you want to leverage this culture of crypto native, this crypto native culture, because two things. One is you can expect to learn a lot from these people, and two is if you contribute information, your insight. Let's say you have some insight in traditional finance, and you think that might be relevant for crypto. You want to share that. You want to write a Twitter thread or a Medium post and help people understand how traditional finance works, because most people in crypto, most crypto native people don't understand how things work. I don't even, like, traditional finance is so complex. I don't even know, like, maybe I know like 1% of how it works, right? So share your idea, share your insights, share your experience, and in return, you're gonna get a lot of help from crypto native people, and that's how you break into this industry and ramp up your knowledge and etc.
I mean, I find it funny that some people say, well, come on, I mean, traditional finance, it's here to stay. The government, I hear comments from Janet Yellen, Jerome Powell. All those people I noted are very, very smart. They figured this out. And the people they have around them, and if they want young, talented people just out of MIT or Stanford, whatever, like that, it's the government. They could pay for it and they have access to that. If anything, the government is discreetly, perhaps behind many of the things that we're talking about as a creative experiment to keep ahead of the rest of the world. Don't necessarily believe what they say. It's the actions that they take and how the government could benefit and how they could profit. I mean, I spoke about this. I think we're going to be heading to a property tax inevitably on Bitcoin, similar to real estate. That'll be a great way for the government to profit, yet allow it to still flourish and run. But let me get off that and jump into a little bit of a deep question. Since Bitcoin is not Turing complete, will those attempting to build smart contracts on the Omni layer ultimately fail?
Well, number one, I don't know that much about the Omni layer for Bitcoin, but I think the main issue is because Ethereum is Turing complete and started around 2014, and the fact that Ethereum made the developer experience relatively easy compared to Bitcoin. Like if the smart contract language in your base layer is not Turing complete, it's just going to create a lot of problems when you try to create another layer on top of it that is developer. Like it's never going to be the same when you lack that fundamental property in the base layer. And Ethereum started in 2014 at a time when, you know, some of the Bitcoin maximalists, quote unquote Bitcoin maximalists, look down on every single altcoin, because everything that happened before Ethereum, almost everything that happened before Ethereum was cheap knockoff or something that would never take off. So the Bitcoin community in the early days totally ignored and dismissed Ethereum. And they basically the window of opportunity for Bitcoin to really take off as a programmable platform was closing around that time. So Ethereum took this opportunity and really flourished. So I think it's really a combination of these factors.
I mean, I know that for the audience, we're doing some things more basic, intermediate, and some very advanced. For those of you that are like, what the hell is this and what does it mean? Take notes, watch it again. Again, I wasn't native to this. I was interested in it and I learned about it. So there's lots of resources out there, but hopefully this will spark interest. What is the importance of Ethereum being a state machine?
This is a very technical question.
Yes.
Ethereum being a state machine basically means that, I mean, again, I'm not really a computer scientist, but my understanding is you can record some important states, i.e. some important data onto the Ethereum blockchain, and you can update it every block, and hence the state machine, right? Like the state machine is a machine where the states can be updated in a continuous way. So what that basically means is the state machine alongside the Turing complete programming language allows Ethereum to store and to update some important, for instance, financial information onto the Ethereum blockchain. And the implication is you can build all sorts of things like DeFi, like NFTs and even DAOs and stuff like that.
What might the regulatory future of DeFi look like?
Yeah, frankly, the regulatory side of things is the part that I worry the most about DeFi, because back to the very first point that I brought up about DeFi is the user experience. But we've seen over in the entire course of history of technology history that regulations can create a ton of friction when it comes to user experience. Regulations cannot completely kill decentralized platforms just due to the nature of decentralization, but they can make using these products very easy, very hard.
Absolutely.
To give you a very exactly to give you a very simple example, the fact that most developed countries in the world tax capital gains on crypto, on Bitcoin, for instance, makes it extremely hard for users to use Bitcoin as a payment system, because every time you use Bitcoin to pay for a product, you're going to have to track the tax consequences and pay tax on that. It's too much, way too much mental hassle. And this is only one of the many potential ways that regulations can cause friction in DeFi. So I worry about it, but I think it's really critical that the industry comes together to push back against the kind of regulations that cause frictions to the users. And I think the industry is coming to realization.
What type of vertical application that hasn't been built yet that you would like to see be built?
Well, to be very frank, so far, most of the applications in DeFi have been highly speculative in nature. And the implication of that is it's like to be very frank, it's primarily 90% a casino. And one of the consequences of that is the value accrual of DeFi is very circular, is very reflexive, in a sense that as more people pay attention to DeFi, people will speculate on DeFi. Trading volume in DeFi will go up. Lending volume in DeFi will go up. But these volumes and lending, and these are basically fundamentals, like the fundamental metrics that people use to value DeFi. And therefore, as more people speculate with DeFi, the value of DeFi go up. So it's very circular and reflexive in nature, and that worries me a little bit. So I want to see more applications that are not speculative in nature. For instance, applications where people can use crypto to pay for day-to-day products and services. Some kind of applications that bridge the gap between the crypto world and the real economy, so that for instance, people can take out a under collateralized loan in DeFi and use that to start a venture in the real world, to pay for something, to take out a mortgage and stuff like that. Something that really bridges the gap between the two. I think it's super important and something I want to see more of.
Oh, for sure. No, that'll be great and obviously coming. What is the biggest obstacle into getting institutions to adapt MetaMask institutional when Codify builds it?
Frankly, I highly doubt institutions will use MetaMask for many reasons. One is it may not be intuitive for them to think of using a browser extension to handle like billions of dollars, right? Like it's just, and to be clear, MetaMask is not entirely safe. MetaMask without a hardware wallet, just this Chrome extension itself is not safe. You don't want to use it for handling millions of dollars. You can use it for like some small payments, which is very convenient, but you don't want to do it as an institution to handle billions of assets. So that's number one, is safety and user experience. And number two, maybe regulations, right? So there might be some regulations that require institutions to use some sort of qualified custodian that handles the assets for them, right? So I think a combination of these two things are the main hurdles, and the regulatory side of things is probably something that cannot be easily solved, at least in the short term.
Do you think MetaSwaps will rival other DEX products? And how long do you estimate it will take for MetaSwaps to be off testnet and onto mainnet?
I know nothing about MetaSwap. I've never heard of it, unless you're talking about the native swap function in MetaMask. But I don't recall people calling that MetaSwap. So unfortunately, I cannot answer that question.
No problem. We'll skip over it. Relative to what we are seeing in certain financial markets, and again, where DeFi could make an impact too, I think we're already starting to see it. They're developing like swap products that traditional banks would use, derivatives. How much experience do you have on that, and what could you impart to our viewers and listeners?
Well, I guess a few data points. First of all, the number one, I guess when we talk about swap, are we talking about like swap in the sense of decentralized exchange, or swap in the sense of interest rate swap, like derivatives? Like,
Yeah,
what are we
more
talking?
the latter.
The latter. Okay. There haven't been. There are many teams building derivatives and like interest rate swaps or spot swaps, even FX swaps. But it's extremely new. There isn't a ton of traction yet. But the most immediate application I can think of for swap is interest rate swaps that allows people to take out fixed rate loans. Because historically, the core lending platforms in DeFi, meaning basically Compound and Aave, these are money market lending platforms. Basically means that the rates they fluctuate. It's a variable rate loan. But there is clearly a demand for a fixed duration, like longer than instant. So it could be a week, it could be a month, it could be a year, at a fixed rate. And one way to achieve that is to use an interest rate swap, right? To swap a variable rate to a fixed rate. So that's something I can see in terms of like swap products that can take off sometime in the next 6 months.
And what will be the regulation and future of the DAO possibly look like? For those that don't know, it's not the DAO from the stock market perspective, it's acronym DAO.
I've not heard of any talks around regulating DAOs. I guess maybe fundamentally perhaps the reason is that DAOs fundamentally are not they're not necessarily financial tools. They're not financial products. They're just tools that enable some application, right? You can think of it as an LLC, as an analogy. It's a tool rather than an application itself. So because of the lack of fundamentally financial nature of DAOs, maybe there's just not that much pressure from regulators to regulate these. So I don't see anything yet.
Okay. And to give people some context, we're probably about halfway through. I have a truckload of questions. Some will probably need to be a bit of a lightning round, and some will be some of Angelo's, I hope, legendary kind of where the hell is that's completely out of left field. Those are coming, I promise. A little bit of a heads up, some things relative to this community and some of my thoughts about things to ponder. And again, you could all learn this, I promise. Besides being a member and getting the most opportunity and access, although Twitter's great, I decided to take a little bit of a fork and actually be very active on this in Instagram, where it's really not that common. My Instagram is simply our company name. I recommend you go and you follow. There's some proprietary content, at least for now, that I give some level of first exposure to, of the kind of questions you should be asking broadly, investing, geopolitical, single family office perspective, and definitely relating to the digital asset community. It simply is at Family Office Association. Go and follow. Hopefully you'll enjoy it. Explain the concept of smart bonds and what are the risks in using Barnbridge application? Barnbridge, I'm sorry.
Yeah, on the very high level, the way Barnbridge works is it tries to segregate risk levels. So for instance, like once again, this touches the fixed rate, variable rate issue in crypto. There are many ways to generate yield in crypto, and most of the yields are variable. It changes, it fluctuates a lot. And Barnbridge basically Barnbridge allows the user to create a senior tranche and a junior tranche, and then the senior tranche basically guarantees a rate. So if you put in a certain amount of money, you will always be expected to receive X percentage of that. Whereas the junior tranche takes more risk in terms of on the rate itself. So the junior tranche people may not necessarily even make money; they may lose money.
Right.
But the EV should be positive in theory, but they take this risk. So This is one product that Brombridge builds, but the high level is to create these different tranches for tranching risk, basically. For me, the main risk of using something like Brombridge is not any different from using other DeFi platforms right now. Is mostly smart contract risks, potentially like economic attacks, risks of losing your entire stash. But most of these like DeFi projects, they get reviewed by smart contract auditors, so the risk is reasonably low. But the risk is always there. And by the way, the smart contract risk is one of the reasons why you see dramatically higher yields in DeFi than in traditional finance. It's one of the many sources of yield, in my opinion.
We had a question that came in from someone via text, actually. I'll read it. And it's a pretty deep one, I guess. What is the difference between a PMM and an AMM? They claim they offer lower slippage and even zero impermanent loss, but how is that achieved?
Yeah. I mean, in terms of definitions, arguably PMM is a subset of AMM. I mean, AMM is a very broad term. It just stands for automated market maker. Basically, in traditional finance, market making is done by professional market makers that inserts and pulls and trades like orders in a very frequent basis. But these are done by like a small set of professional market makers that account for like 80% of market share. In DeFi, AMMs allows anybody to provide liquidity via an algorithm to a decentralized exchange. So first of all, that's a very powerful idea. But in terms of the actual algorithm of how these orders are inserted and pulled and provide liquidity, there are many ways to do that. So Uniswap, for instance, used one of the most basic, but it works really well. And PMM is a more specialized way with a slightly fancier. I don't even remember the details, but it's one of the variations, one of the like implementations of AMMs. In terms of the claim of no impermanent loss, I think that's one of the biggest misconceptions that even crypto native people have, is that like there's no such thing as like zero impermanent loss. It just does not make any sense, because in the very short term, it is a zero-sum game between the liquidity providers and the liquidity takers. If you say that the liquidity providers have zero impermanent loss, meaning if the liquidity providers make no money, that means the liquidity takers are making a shit ton of money. It's a zero-sum game, and it's a trade-off. So like such claims are usually not true. That's the high level.
Many algorithmic, what did I mess that one up? It happens every podcast. You get it. Algorithmic crypto products have not delivered as promised. Do you agree?
It's a very vague question. I mean, I would say just in general, 90% of crypto products have not delivered the promise. So, but I mean that's the nature of a new, highly risky field. Like most products fail is natural.
Yeah, I mean, and that goes back to my bigger picture point that I made earlier. For many substantial investors and family offices, I know this is hardcore kind of fire hose. This is early on. And you may elect to say it's intriguing, but I'm going to stay on the sidelines. And if that's your thesis and decision, I do understand. Many of you just can't ignore Bitcoin and Ethereum. So whether through institutions, you're getting someone involved. And I think that's good to carefully measure your risk, but at least have a foot in the door that would motivate you to want to learn more. But in terms of the massive asymmetrical returns, it's early on in this kind of stuff. Liquidity may be a problem in some of it. Some of it absolutely may go to zero. But again, and I'm using very simple numbers, with asymmetrical, you put in $1,000 with no leverage, all you can lose is that. The upside, could be substantial, way, way, way more than more traditional asset classes you're more familiar with. But there is a dearth of resources in our community. There's actually a family office. I'm going to say practically none. I'm probably by far the most active person broadly in the digital asset space relative to the $100 million plus family community. So, just educate yourself, be a part of an organization like ours, look at some of my free content. And, like Qiao's saying, Twitter has been great. And many of the great thinkers and thought leaders that I've had on, Michael Saylor, Plan B, Qiao, and many others, they're all on Twitter. Many of them I personally have met through Twitter, and it is a great resource. I like the Wall Street Journal and the Financial Times too. But if you want to be more active in this community, that would be a little tip that you gave, which is great. I'm just trying to be a little different, going a little more of the Instagram route. So we'll see. What are the risks in structured products like Data Vault?
First of all, I know nothing about Data Vaults. Once again, there's literally like hundreds of, or if not thousands of teams building similar projects. So most of the products I've not even heard of. But I guess structured products, again, the smart contract risk is one, but most importantly, you need to understand, I think most of the structured products in DeFi these days, they use some kind of options. So you need to understand where the yield comes from, why options are priced higher than at a certain times over others. So you need to understand the market. The yield, I guess, arguably it comes from the theta decay of options, because these structured products, they tend to sell calls and puts. But it could also come from potentially a extremely high implied vol, because sometimes the market just gets super euphoric and buys a shit ton of options. So I think for me, the main risk is you need to understand where the yield comes from.
No, that's a good point. A little bit of a deep one. Companies like Pendle are increasingly building decentralized alternatives to interest rate derivatives in traditional finance. If these products eliminate traditional black swan risk, will it introduce new ones?
Well, I don't think so. First of all, we're investing in Pendle. They're one of the best teams we've come across. But I don't think in general, DeFi analogs of CeFi products will necessarily eliminate black swan events. For me, I guess one potential advantage of DeFi is that in theory, the positions, the assets are transparent because they live on a transparent blockchain. So in theory, you can analyze the risk of the systemic risk, the overall systemic risk, because everything is available to you. But then again, it's difficult because there's so much data. But the other thing is, aside from that, I think DeFi does introduce some risks, additional risks relative to traditional finance, because in traditional finance, again, the traditional finance makes a trade-off between things being siloed and systemic risk. I think one of the theoretically nice benefit of having things being siloed is that there's less interaction between one giant, let's say, custodian with another giant like prime brokerage. Right? There's less interaction with them. Whereas in DeFi, you have all these different products and services where the assets interact so easily with each other. You can leverage so easily among each other. There's no regulator, at least yet, or there's not much self-regulation that tells each one of these services, you cannot leverage over, let's say, 10x, right? No one tells you that. And therefore, the leverage can go drastically higher than potentially than in traditional finance. So it does introduce a little bit of additional risk. But so far, we have not seen like a systemic, like total meltdown or deleveraging of the system yet. So I guess we'll see.
Are the rates in Alpha Homera too good to be true?
I don't think they're too good to be true. I think the first product that Alpha built was a leveraged yield farming product.
Yes.
So, by definition, you're taking more risk to generate more yield. I don't think it's too good to be true. You're just taking on more risk.
Will Definity disrupt Amazon's AWS?
This is a good question. I'm not so much of a decentralization maximalist. I think at the end of the day, the centralized computing platforms and decentralized ones will make some trade-offs between each other. So there will be niche use cases for both. I think there might be some disruption, but it's very hard to say. It's very hard for me to say.
And Qiao, I have to ask you this question. Are the recent popularity in meme tokens a signal that we're living in a simulation?
Well, I think it's quite likely that we live in a simulation, but that's unrelated to crypto. But I think the recent rise of things like Dogecoin is a sign of several things. One is there's way too much money, capital sloshing around the system, central bank liquidity. That's number one. Number two, we might be near the last few innings of the bull market because the retail obviously have come in. You see all these, you see the rise of crypto TikTok, where everybody talks about these meme coins, and it's a sign that it's a sign of froth for sure. I don't think we're at the top, but it's definitely a sign of froth. So I think this is some of the things that oh, and also it just tells us how powerful memes are when it comes to crypto. I think a lot of the crypto value accrual actually comes from it's directly correlated with attention span of people, the aggregate attention span, rather than cash flow, which traditional finance people generally use. So memes definitely adds more attention span from the community. I think this is some of the things that I learned from these meme coins.
Yeah, we're going to dive into Doge and some of the other things you mentioned actually relatively shortly. Another question that I ask people, the maximalists tell me to stop asking it, but I'm still doing it. If the 50 Bitcoin in the Genesis block were moved, would we no longer be able to transact on the Bitcoin blockchain?
Why is that? I don't really get it. I don't know why that will prevent us from transacting from maybe there is some technical reason, but I'm not aware of any.
Yeah, there's some that would say potentially that would instantly stop the miners, I guess you could say, from getting paid. And that brings up a whole series of questions. SHA-256 in the mid-90s, possible NSA involvement. Who is Satoshi? Is part of it part of the US government? Was it Hal Finney? I mean, there's lots of interesting questions there. I threw out a whole bunch of stuff at you. Plan B did tackle those pretty aggressively. Is there anything in what I said that you want to address, or you want to skip on to the next question?
I mean, there's definitely a concern with Satoshi actually being alive and in control of their assets. That might freak out the market. So like every time a very early set of Bitcoin that move on the blockchain, the market somehow gets spooked. So that's definitely a concern there. But again, it's a short-term concern.
Is BitClout a Facebook killer, or is it a scam? The founders are anonymous, and you can send Bitcoin to buy BitClout, but you can't easily withdraw BitClout from the site.
Yeah, BitClout is not a scam. We know who the founder is. They're backed by some of the top VCs.
Who is the founder? It's anonymous.
The founder is the former founder of a stablecoin project called Basis. I think this is public knowledge because people recognize that on Twitter. Again, get on Twitter and you know this kind of stuff. So it's not a scam, but
then is it a Facebook killer?
I don't think it'll kill Facebook. I think if the idea works, Facebook will adopt it. I think the idea of social tokens, being able to speculate on personal tokens, it's a fascinating idea. I love the idea.
Oh,
I think
sure.
I think Big Cloud has not executed perfectly so far. But the general idea of social tokens, I think is going to work.
Yeah, I mean, my brief opinion, Zuckerberg is brilliant. If Facebook had their way, they'd be buying up companies like there's no tomorrow, but antitrust and some of that has made that very, very difficult. They may be able to recreate internally, but at big companies, sometimes that's hard. So I am interested in that question and seeing how that kind of plays out. How is the graph different than Chainlink?
Okay, that's very simple. So Chainlink brings data from outside of the blockchain onto the blockchain itself. So for instance, Chainlink can bring data from like a centralized exchange into Ethereum, whereas the graph provides data from the blockchain to someone who wants to use the data. It could be an app developer who needs data from on-chain. So the two are very different.
And I mean, I did post this on Instagram. I got some interesting responses. Relates a little bit to Doge and some of the things you spoke about. Kind of 3 key questions to make money in the new digital era. And what would that be? What will get a network effect? What's going to get adoption? And lastly, and pretty important, what will develop a cult-like community? Now, I know that's like, hey, that's going to sound a little bit like Doge, but what would you say to that 1, 2, 3 sequence? And is that something to monitor? Because that could show the belief in a community and how powerful that is.
Yeah, again, like I said this like maybe 5 minutes ago, like the community is, for me, that's probably the factor that correlates the best with the price. It's not cash flow. It's the attention. It's the mind share. There are so many projects that are trading at billions, if not tens, hundreds of billions of dollars, that have a shitty product, that barely works and no users, but they have a huge community. So I mean, at least when it comes to short-term speculation, that's something you want to monitor. I think in the long run, when it comes to like 5 to 10 years kind of time horizon, I think usage is what matters the most. But the market has not come to its sense yet.
Kind of 2 more technical questions, then we'll do lightning round on a couple of a little bit more fun and more lighter stuff. But merged mining, gateway to EVM bridge, what do you think?
I know nothing about it, unfortunately.
Okay. Proof of work on the blockchain, but now going to proof of stake. Opinion on that?
I think it's fine. Like, you're making trade-off, and like when it comes to Ethereum, which is mainly a programming infrastructure, application infrastructure, rather than a money like Bitcoin is. I think proof of stake is fine. It's the right trade-off.
How long will it take for zero knowledge proofs to become part of every blockchain application?
Yeah, I mean, we've been talking about this since like 2016, but it's not like zero knowledge proof is moon math. It's very difficult. Like Zuko told me there's probably, like, he doesn't even understand the math, and there's probably less than like 10 people in the world that really understands it. So it's very difficult, but it is a civilization changing technology, I think.
Is Solana a threat to Ethereum?
I think it is. When it comes to market share, I don't like it. More likely than not, Ethereum will still be the front runner for the years to come, but Solana is probably going to gain more market share.
And maybe a little surprisingly, is Doge actually a better payment system than Bitcoin? It's cheaper and faster.
Well, when it comes to, I mean, this is a very old debate, cheap and fast. Well, cheap, it just means that no one is using it. I don't think being cheap is necessarily a good thing. being expensive means that a lot of people are using you. Being fast, that's a total misconception. Because ultimately what matters is, I think it was Nick Carter who came up with this idea of assurance, settlement assurance. It's not about the time. It's about how confident you are that this transaction that you just made is fully settled by the blockchain and secured by the blockchain. I think that's the most important thing.
And a little bit, because I do get so many questions on it, we did cover it a little bit, but relative to Doge, I mean, I could broadly ask, what do you think of Doge? But if I had to dive a little bit deeper into something more technical, possible to build on top of Doge, kind of a soft fork of Bitcoin, like layer 2 Bitcoin now, but it's not Turing complete, no state machine. And maybe here's the question, is Elon Musk trying to use merge mining to bridge Doge, where you can build smart contracts, and that will take a hell of a lot of money?
I mean, everything is possible. Yes, you can develop a programmable interface on top of Doge that people can build on top of. But there are so many factors that come into play. Like already we have a handful of Ethereum competitors that are very advanced in the game with the organic community. Like the tech itself is not everything that matters. In fact, the tech itself matters very little. Like for me, the Ethereum tech is probably the worst among the Ethereum competitors. But Ethereum is, for me, it's like the JavaScript of blockchain. The tech is so bad, but it is the front runner. It is the first mover. And because of that, they build tools on top of it to help developers to facilitate development. And then there's a very large organic community around it. And that's the beauty of open source projects. The tech is not the most important thing.
There's certain things on your Twitter that I loved. I took a brief look at it in a couple of days, and here's one that pops up. We kind of covered it a little bit earlier, but feel free to jump in. I believe you wrote, central banks are the most powerful institutions in the world. They create perverse incentives that subtly and indirectly drive every single one of your actions and decisions, and you don't even know it.
Well, I mean, fundamentally, what I meant by that is most decisions that we made in life, either directly or indirectly, involve money. You pay for something, you buy a house, all these things, even like health-related or relationship-related things, they almost always involve money. And what is money? What is the price of money, right? It's a few things. It's the supply of money. It's the interest rate of money. And all these things are ultimately driven by central banks. So there's like this downstream indirect consequence from the central bank decisions onto every single action in your life. I think most people don't realize why Bitcoin matters in this regard.
No, that's a very good point. Someone commented, I believe, on one of your posts. We kind of covered a little bit earlier, but I think they might have said Solana and BSC are only attractive because Ether has high fees. If they fix those fees, then why would anyone choose anything but ETH to build or transact on? You may have disagreed with that.
So fees is not, it's an important factor, but it's not everything. The trifecta of what matters is fees, throughput, and latency. All three things are related to each other, but they're all different. If the fees were low on Ethereum, but the throughput is low and the latency is high, it means, for instance, that professional market makers will not want to make markets in Ethereum-based decentralized exchanges because latency and throughput are so important for them. That's how they get an edge over other players in the market. And that's one of the biggest reasons why, for instance, Jump Trading, who is probably conservatively top 3 market maker in the world, probably number 1, decided to support Solana and trades on Solana. And that is not just because of fees, it's because of the high throughput and low latency of Solana. That said, you can achieve similar characteristics with layer 2s on Ethereum. So we'll see how that play out.
What is the future of stable coins, and how will central bank digital currencies perhaps impact their future?
So number one, I think stablecoins are probably the most important application on blockchain since Bitcoin and Ethereum. It's the single most used application. If you think of it as an application, it's probably the single most used application in DeFi or blockchain. I've seen quite a few people who are not crypto native that start accepting stablecoin to fund their business, to accept payment, etc. So I think stablecoin are going to get massive, but it will take a long time because it's a chicken egg problem. Like it takes time to bootstrap this network of users, starting from the crypto natives, and eventually expand to the non-crypto natives. I haven't thought too much about the impact of central bank digital currencies on stablecoins like USDC. I think at some point, people are going to build some interoperability tools to link the two so that you can easily transfer from one system to another. I think that might happen, but otherwise, I don't know. I haven't thought too deeply about it.
I'm looking at one of your tweets that I copy and pasted, and I know we've covered Doge in and out a little bit, but I think it's important for my audience that maybe, I don't know, although I have cyberpunks and others, but a little older, more conservative investors, but are getting intrigued by this. And I understand their perspective. They look at it as, come on, this was a meme of the Shiba Inu dog. The creators did it as kind of a joke and a spoof. One of them cashed out early. And like, really, it's the power of memes and social media influencers. Well, when I gave you my 3 reasons of things to look for earlier, I know this is hard for people in more traditional finance to wrap their arms around. It has a powerful, powerful community. And you already mentioned that, the value of that. But I think sometimes people are going to have a hard time wrapping their arms around that one.
Yeah, I think the way to think about this is, for me, every market in the world, whether it's crypto or traditional markets, everything is based on memes. It's just that different generations use different memes. In the traditional institutions, I think the memes for them is cash flow. It's things like cash flow. It's things like GDP. It's things like these quantitative this and that. In the millennial and even the Gen Z generation, the meme is like funny things like Doge, right? Yeah. Like for me, everything is based on, like, all the value accrual, all the market price actions are based on memes. It's just that different generations use different memes. So I think my advice is just be open-minded to what other generations use as their meme.
I know, and it's hard, and Gen Z is a big population too. So to think that they're not going to come into a position of power and authority, just like even the younger millennials, those under 30, I mean, come on, you're fooling yourselves. That being said, I guess both you and I and others have chuckled. I mean, look at the returns so far this year in Doge, and even, it sounds boring now, but Bitcoin and Ether, comparative to what, maybe 20% of the stock market. We're talking thousands of a percent sometimes in multiples. This can't continue, but we don't know when that's going to stop. And maybe it's like the first couple of years, a long, long time ago in the stock market. It's wickedly inefficient. It's very choppy. There'll be ups and downs. There'll be booms and busts. But depending on a variety of factors, there'll be wickedly asymmetrical opportunities that may not be with us in 10, 15, or 20 years.
Yeah, I think, first of all, to your point, we're definitely not early in the bull market. We're at best in the middle, probably late, maybe a few more months. There's also this idea that spreads around about, like, the super cycle idea that this is the one cycle that ends it all. I think it might be true to the extent that at some point we're going to have a big dump of I don't know, 30, 40, 50%, but because of the central banking liquidity, that's just going to the central banks just can't stop printing money. Like there's no way out for them. So this will still last maybe a few years, and this liquidity will continue to drive crypto because at least Bitcoin, where it is today, is
is big enough to start trading alongside the rest of the macro markets and really be affected by the sheer amount of liquidity that's sloshing around the system. So we're gonna dump, but as long as the money printing continues, this bull market, it might be a more steady, very long, choppy bull market, purely liquidity driven. That's on the macro level. Now, I think the nice thing about crypto is there is so much alpha. Even if you're bearish on the beta, on the macro, you can still make a ton of money in alpha by picking picking individual individual crypto assets, because of the level of there's so many areas of information asymmetries. There's information asymmetry between the Twitter people and the people not on Twitter. Once again, there's information asymmetry between the East and the West, because the two worlds are so disconnected right now in terms of information. There's so many ways to find alphas in crypto. That's my high level.
Yeah, I mean, I told the audience this. I don't know why at my age, but I purchase things like Ethereum t-shirts, polka dot t-shirts. I go to the gym a lot. I get approached practically all the time. If I wear I don't know, name a FANG stock outside of maybe Tesla, I would never get approached. Young people. And then I ask them, really deep, do you use MetaMask? Do you go on Uniswap? Do you know what Rally is? They all know it. They may not be computer scientists, completely grasp it, but this is again, it goes back to the meme culture. It goes back to the Generation Z, the fluidity with technology. And when you ask them about the stock market, they're like, oh, that's corporate, that's centralized, that's what, 10-20% returns. One of them told me he made $11,000 and he has he's young, he's like a teenager, on the increase in Doge. They're taking their stimulus checks, they're investing it in things like this that believe in their community. Again, very volatile, very concerning in some ways, but this is what they're doing, and you have to realize it, which would concern me from multiple different perspectives, meaning, are they kind of right? And should we have more exposure to some of the things that they're talking about? Because this generation is going to drive a lot of things. And you just nailed it perfectly with, could be incredibly frothy, a bubble, but oh yeah, there's tremendous asymmetrical and alpha in there, possibly due to some of the right choices. So I find my social experiments of interacting with people, like I do when I walk down the streets of New York and walk into businesses and ask them how things are going during COVID. And now stopping people, I got to start to record some of these, really, really interesting conversations.
Yeah, for sure. I mean, crypto is first and foremost a social asset class versus the traditional equities.
Maybe my last one. Bitcoin dominance, I guess you could say, is under 50% now. Is that first time ever? Ether dominance risen to about 15%. Kind of what does this tell us? Is inevitably, eventually, parity coming?
Parity between Ethereum and Bitcoin, or?
Yes.
Yeah. Well, I still think it's unlikely that Ethereum is going to go parity with Bitcoin. That said, I have raised my probability estimate of Ethereum eventually overtaking Bitcoin for, I guess the main catalyst is really EIP 1559, which is a proposal of, on the high level, burning Ethereum fees, burning the ether that's being used as fees. So that can potentially create a deflationary pressure, or that can potentially turn Ethereum into a deflationary asset. So Bitcoin has a hard cap of 21 million, but Ethereum supply could potentially go down over time because of the fees and the level of activities. And that is extremely bullish for me when it comes to Ethereum. And the fact that the vast majority of DeFi is being built on Ethereum, I think, I've definitely raised my probability estimate.
Yeah, I mean, same here. Back a little bit to the issue of being early frothy markets, and that's where the excitement is in the alpha. I mean, listen to Plan B and others. If it follows the halving cycle and how things went up and down, we may have a good run through the remainder of this year, but sometime after that, next year, early into that year after, I mean, it has normally hit like 85 to 90% down. You could argue it's different this time. There's truth, institutional players, an ETF coming out, RIA is going to get involved, selling it to middle America. I hear you, but likely there still is going to be the point, like you said, where there may be a 30 to 40% or more hit. Some of you are going to say, see, I told you, but that's all relative. Let's use the example of, oh, I didn't buy at 2,500. It goes up to $500,000 a coin, and then it does whatever, take a 40% hit. Okay, you're still better off than if you did nothing. So there's always going to be naysayers from that perspective. To some degree, you have to be in it for the long term, knowing that we may hit a nirvana closer to 2024 to 2028. And you don't want to be the one that got out too early. But then that begs the whole thing about a thesis on an investment. What would cause you to change your opinion? You should always think of that. And does a better opportunity come along that you may want to get out of something? And there's no easy answers for any of that. You're going to have to form your own thesis and your own conclusion. But to think that the kind of returns we're seeing this year, we're going to continue and continue and continue forever, that, come on, that's not going to happen. Do you have the stomach to do your research, your thesis, to stay in it, but to also know when to cash in your chips and when possibly other opportunities may be more applicable? Qiao, why don't, in wrapping, you tell people a little bit about the DeFi Alliance and how they could learn more and how people could follow you on Twitter?
Yeah, the DeFi Alliance is an open consortium of almost 100 organizations and individuals in crypto that all come together and provide resources, provide support, provide help to DeFi startups, or just really crypto startups in general. And we also invest in some of the startups that we support. So you can really think of us as the Y Combinator in crypto. That's the simplest way to think about it. We started about a year ago. I'm one of the 3 partners there, and feel free to follow the DeFi Alliance on Twitter. You can easily search for the DeFi Alliance or Google it. You land on our website. It looks like shit right now, but we're gonna revamp it in a couple months. It's gonna look really nice. But before that, before the DeFi Alliance, I come from a traditional finance background. I did quant trading, etc. But yeah.
In terms of following you on Twitter?
Yeah, you can follow me, QWQIAO. That's my Twitter handle. Or if you search for my name, it's probably one of the first ones that come up in the results.
That is true, and I highly recommend it. It's a great Twitter follow. And Qiao's first name is spelled Qiao and last name Wang, W-A-N-G. And everyone, I'm Angelo Robles, the host of the Angelo Robles podcast, the founder and CEO at Family Office Association, a global membership organization dedicated to wealth creators, substantial investors, and their family offices. Check us out at familyofficeassociation.com. And although I'm active on many social media platforms, the 2 that I probably have been most creative and active in have been Instagram. Simply, it's the company name. So go and follow us, Family Office Association. And we're Family Office, very simple, with my channel, the Angelo Robles podcast on YouTube. Really enjoyed today's conversation. Qiao, thank you so much for dropping tremendous knowledge and dealing with my questions. You were great, and I look very much forward to the next time. Thank you.
Likewise, take care.